We back with a video, man. This one is well requested, man. A lot of people been asking me for this, so y'all know I had to get to it. This video is showing y'all how to buy options on Robinhood. Now, this is just a quick run through, I'm gonna drop a couple gems for y'all so y'all can basically get started, know how, where, and what to look for when buying a contract or option contract. We're gonna start off with this video just with a call option. Right now it's after hours, so this is just like a demo or a mock walkthrough of what you would do to purchase a contract. So what you do is type in Tesla in the search bar, whatever screen you at, you come over here where it says trade Tesla options. Now if you're on a phone, it'll look a little different, but it's the same layout. You just scroll until you see this. Click on here, boom. It'll pull up. This is called the options chain. Now once it pulls this up, this is where you can select which option you want to buy. Now the important things to note. So to know you're here at Tesla, it says the name right here. The current share price is listed right here. The percent it gained today is here. This is the ticker symbol, TSLA, which that means you could just type in TSLA and it'll bring Tesla up, and it's telling you this is a buy call option. So here, right here, we have a buy and sell button. So you can switch it over by clicking either of these buttons. You see when I click sell, this here changes over to sell. When I click buy, this changes back to buy. So you want to make sure, especially when you're new and starting off, that this is on the buy button. I made this mistake. I made this mistake a couple times by rushing to get an option, because I see the price moving in the direction that I think is going to go, and I jump in real quick to buy one, but it was accidentally on sale. So I ended up in, it's just, you got to just make sure you're not making that mistake. Make sure it's clicked on here. But what I ended up doing was I bought a put instead of a call. So a call option, now this is the ones you usually see me buy, betting that the stock will go up. I like to bet that the stock is going up because the stock market moves in an upwards direction. Now, you don't want to buy a call option, which is betting that the stock is going up when you are in a downwards trend. You want to make sure that the stock is in an overall upwards trend when you're buying call options. It could be at a low point on a dip, but the overall trend should be on a upwards trend. Now, here we are. Like I said, you can click this to buy. This is all you want to focus on, making sure it's on the buy one. And then for right now, until we learn or until I show you how to do put options, focus on just call options. Unless you want to just try it out and you already know what you're doing because you watch some videos on YouTube or whatever, then feel free to try it. And remember, this is not financial advice. You know what I'm saying? This is just me sharing what I learned, what helped me, and trying to make it, make a shortcut for y'all. So you make sure it's on buy call option. Now here is the date. Now this date is important because this is the date your contract will expire. So all these contracts have an expiration date. So with these contracts, you're basically betting that the share price will reach a certain price before a certain date. Now when the price begins to move up, basically every dollar is moving up. You make money off of that if you got a contract close enough to the money. If your contract real far out of the money, then even if it goes up $1, you might not really see any change. So one of the risk management rules that I learned that I just want to share with y'all, even though I don't use it so much, you want to make sure when you buying one of these contracts, the price should be 3 to 5% of your total account value. So basically, you don't want to risk the entire amount of money that's in your account. You only want to risk the amount that you're willing to lose. And that amount shouldn't be more than, generally, it shouldn't be more than 3 to 5% of your account. Now, let's say you're feeling a little more confident and you know what you're doing, then you can risk a little bit more money. Like me, I don't follow that rule. I'll risk, as much as I want to put, because the more you risk, the more money you'll end up making. But also, on the flip side, the more money you could end up losing. But I have a higher risk tolerance than most people. And because I'm also using money that's invested that I wouldn't mind I mean, of course, I'll mind if I lose it, but it wouldn't, you know, it wouldn't mess everything up for me. So make sure you never putting in more than you're willing to risk. You know, don't put your last money in. Only put what you can afford, you know, to put on the table. And if it happened to, you know, disappear or you lose it, you know, it wouldn't put you in a bad position. So here we are, we looking at some different options. So let's just say we had an account that was $1,000 account, right? So let's just say $1,000 account, and let's say we were going off that 5% rule. So if your account was at $1,000, the most you would want to spend on a contract is about $50 if you wanted to go with that risk management tactic. Now I would recommend at least maybe like 100 or two, you know, just so you can see something decent if it does move. But you can do something with this 50 though. So I'm gonna show you right now what you can do with 50 if your account was only at 1,000 and you only wanted to use 5%, or let's say even your account was at, you know, $100 or $200 and you were willing to risk, you know, if it was at 100, you were willing to risk half of your account to get this option, then this is what you could do. So here, this line here where it says share price, this is called at the money. So anything below this line is considered to be in the money, and anything above this line is considered to be out of the money. Now, generally, you want to get stocks that are, or you want to purchase contracts that are in the money if you can afford it, because it'll make money faster and it's closer to breaking even. So it just makes it a little easier for you to see some gains on it. And also, when you click here, so when you open it up, the theta on the contract is generally higher the more in the money you are, but the delta is higher. So the delta is the amount of, just to make it real basic and simple to understand, delta basically you could think of that as standing for dollars. That's the amount of dollars your contract will increase every dollar that the share price goes up. So you see this share price right here at 693. Let's 693.40. Let's say it goes to 694.40, and I had this contract. I would have gained $54 on it. Delta is also a little gem for y'all to remember. For y'all that's a little bit further ahead, or y'all that'll come back and watch this and understand what this means later on. This is generally looked at as a percentage of how likely your contract is to land or end up in the money. So you can say this contract has a 54% chance of ending by expiration in the money. Now, it'll definitely, in general, it'll see some profits before then, but let's just say you decided to hang on to it until expiration, which is January 8th, it's a 54% chance that it's likely to fall in there or to still be in the money. Now, theta is time decay. Now, time decay is the amount of money or the amount of value your contract is losing every day from you holding it. Now, when you buy these contracts, you can think of it like an ice cube. Just imagine putting an ice cube outside in the sun, like on a summer day. The sun would melt, you know, the ice cube, and as time passes, the ice cube will get smaller and smaller and smaller because the sun's melting it away. It's pretty much the same thing with an options contract. The time is basically like the sun, and the contract is like the ice cube. So the longer you hold it, the longer this contract is in the sun, the more value it begins to lose. Now, this number here, this is a dollar amount. So you see how it says 1.33? That stands for $133. So let's say this was 100, this was 122. That would be $122. Or let's say this was 1.11. That would be $111. So outside of the decimal here is the hundreds and tens and the ones place. So whatever this is just basically times it. You could just round it up to 100. So these are the two most important numbers you want to pay attention to. The gamma, this just basically means the amount of money that your delta will increase per dollar increase of the share price. So let's say this goes up $1. Not only will I be getting this $54.90, because this right here stands for 90 cents, so $54.90. Not only would I get this, but I would also get an additional 65 cents of gamma added on to my delta. So now let's say I bought this contract let's just say for instance, I bought this contract here. This is how you would actually buy a contract. You would click, so you can close it and open it like that. You just click on this bar anywhere here to open it up. And then to add it, to buy, you want to pull it over to this section by clicking this plus and then continue. So what it's showing you right now is you're buying a long call, means buying a call at 690 strike price. So the strike price, which is here, this is the price I'm betting that the stock will reach, or the share price will get to. So let's say we are at right now the share price is 693. So let's say I wanted to get a contract that was a little out of the money. Let's say by January 8th, I believe that this stock could hit $700 a share. So I would come here, click this 700. I would look at it, check out the information on the contract. So we can see that this contract has a $48 delta and $132 theta. That's the main things that I look at. I mean, also you want to look at implied volatility. That's a little more advanced. So right now you just want to focus on these two, it's called the Greeks, the delta and the theta for right now. The vega affects volatility. It's attached to the volatility, and rho is attached to interest rates, but you won't really have to worry about this for right now. And also in the course, we go over this, we break this down a lot, you know, we go more into depth on this. But let's say we wanted to buy it. We believe by January 8th that Tesla could hit $700. Every dollar it goes up, I will make $48. Every day I keep it, it would lose $132. So let's say I pulled this up, I added this one to buy it. I said, okay, 700, this is the correct date. This is the price you will be paying. Now, this is the premium price, but when you buy an option contract, you're buying the right to purchase 100 shares by the time of expiration. So let's say before this date. So you have, if Tesla reaches $700 before this date, I have the right to purchase 100 shares from whoever has this contract, whoever sells this contract to me for $700 a share. So let's say even if Tesla went up to $750 a share or $800 a share, this person would still have to sell me 100 shares of Tesla at $700. Now that's if I decided to exercise the contract, which exercising the contract just simply means that you want to use your right to purchase that 100 shares at that strike price. Now, instead of exercising the contract, you could just sell the contract back to the market for whatever gain the price made on it. So right now, this contract is each share in this contract will be $21.45. So times that by 100, that would be $2,145. So they basically showing you how much it would be for one right here. So you'll click continue. Now here it says contracts, 100 shares each. It's letting you know that it's 100 shares in this contract. Here it says limit price, $21.30 to $21.60. So the limit price is the bid and the ask price. The bid price is the price that buyers are willing to pay for this contract, and the ask price is the price that sellers are willing to pay for this contract. So the sellers are the people that own the 100 shares that are willing to put their shares into a contract and sell it for a premium. This price here, this is the premium. Now this price here is the mid price in between these two prices. So whatever the bid price is and the ask price is, Robinhood automatically gets the middle price, and that's what it puts the contract at. So if you wanted to buy the contract for market value, this is market value price right here. This is how much you would be paying. So you would just click right here in the contract box. You would put one contract or however many contracts you would want to buy. Now you see one of these contracts will cost me $2,145. All you would do now is click review. I don't got enough buying power right now to buy this, so it wouldn't be able to go through, and it's after hours right now. but I'm just showing y'all what it would look like. And then it should say like submit after this part, I think. So I'm gonna go through and break this down again. I'm gonna actually show y'all with like a $50 contract for y'all that don't have this amount to play with yet, or just ain't, just ain't comfortable risking this amount yet. Because I definitely don't recommend you risking anything over a couple hundred when you start off. No more than $500 should you be risking. Or if you got it to risk and it really wouldn't hurt you, $1,000 to put it into your account. But don't use it all at one time though. So now if I had enough funds in here, it would just say submit right here. And then this button would say cancel. But since it's, it's not enough in here, this is just an example. But now let's get out of this contract and actually go to a contract that would have been for like 50 bucks. So we would, because the contract would have been 50 bucks, we would have to get something that's called out of the money, which is above this line here. Out of the money contracts are just cheaper, but they gain profit, they gain less profit, and they're further to reach a break even point, and the strike price is higher. So the strike price is just the price that you're betting it will hit. The higher you bet that it will hit, the further it is away that that the share price has to move to reach your break even point. Now, a lot of people think that you got to keep the contract all the way until expiration date before you can make money on it, but you don't. You could actually sell the contract before the expiration date. Now, that's another gem. A lot of y'all, I see hold contracts until they expire and then are confused on why, you didn't make money. You have to sell it before it actually expires, or else it'll expire worthless. So buy the contract, even if you want to swing trade it. Swing trading is just buying a contract one day and holding it until the next day and selling it on that day, or a following day after that. That's generally a smart way to start off. Buy a contract at some point in the day during the dip when the stock is at its lowest. Buy a contract if you know it's going to go back up. And then once you buy that contract, hold it over until the next day and then sell it the next day. But now let's go to a $50 example here. Let's see. So these contracts, this will be a $1,500 contract. This will be you see it says $6.58. Just times that by 100. This would be a $658 contract, a $515 contract, a $318 contract. So this would be a $200 contract, a $143 contract, a $106 contract. So it's a lot of different contracts in here for every price range for a lot of people who think that they can't afford contracts. See, even as we get further in here, we go $90 contract, $80 contract, $60 contract, $44 contract. So we were in that $50 range. So let's see what we could have got for less than 50. So with this, we can get a contract that has a delta of $1.57. So that's the difference. Remember when we were further in the money, that contract had a delta of like $43 or something like that. Every dollar it gained, we would have gained $43 from getting a contract, that contract that we were looking at that was further in the money. But because this contract is further out of the money, which means it'll be cheaper for you to buy, but it's less profitable. So this contract, you would only make $1.57 every dollar that Tesla went up. So let's say Tesla went up $10. You would make $1.57 on that. So that would be $15.70. So you would have paid $44 and made $15.70 if Tesla went up $10 after you bought it, and then you sell it back to the market and keep the profit. Now that's the same thing. So let's say something that, let me look at some of these. That's got a $2 delta on it here. That's what I like to look at. I like to look at the deltas and make sure, it's a decent amount of money on there, because I don't hold the contracts a lot of times until the next day. A lot of times I sell my contracts the same day. So I don't have to really worry about theta getting me too much, because I'm going to sell it that same day. I just have to be sure that I buy it at a low point and that it's going to reverse and go back up from the point I bought it at. So let's go a little bit lower. So we see those contracts had like a delta too. Now let's say this contract here, this is a $16 delta. This will be something, you know, more reasonable to work with. Even, no, let me see. Because a beginner might feel, that's $515. A beginner might feel that's a little risky. Let's say $200, a $200 contract. Let's see what you could do with that. So you would have a $7 delta on there and then a $49 theta. So it would lose about $50, $49.99 a day, which is about 50 bucks. It would lose that every day, but you would gain $7 every dollar that Tesla went up. So today Tesla went up, let's see, I think it was about like $24, $28 or something like that. Okay, so right here we can see Tesla went up $28.79 today. Let's say you would have bought this contract right at the open today. $7 and it went up $28.79. So $28.79 times $7.26. So you would have made $209 on this contract here if you would have bought it right at open and sold it, you know, right at close. So you would have paid $203 and you could have potentially made $209 on it. Now y'all see me buy a lot bigger contracts because I just like to make faster money on it. You know, I'm comfortable risking a little bit more money to be able to make, you know, more money faster. Because now let's say with this contract was only $203 right here. So if you want to buy this contract, you would just click plus, add the 1 right there, review the order. Now make sure y'all stick, you know, through to the end of this video because I'm gonna drop a beastie gem on y'all. But so you would just do that and click, you know, submit your order. This button right here would say submit, this will say cancel, but I'm just, you know, showing y'all for demonstration purposes. So now let's see a contract that I would have probably been willing to get something more in this range, like at least this $658 on there or this 5 one. So let me see the $658 contract. So this contract has a $20 delta on this $658 one. So I would have paid $658 for this. Every dollar Tesla went up, I would have made $20.22. So it went up $28.79 times $20.22. I would have made $582 on this. So that's how I be making money with these contracts. I buy it at one price and I let the share price run up and then I sell it back to the market at another price. So that's the simple gist of it. I hope I didn't make this too long. You know, I know this video is going to be kind of for a lot of beginners or people who never really seen this before. So I'm trying to, you know, kind of keep it simple. But again, so say I want to buy this contract. Let me cancel that one out. Let me cancel this last one. I would just basically, I'm going to cancel this one out, but you would just add the contract that you want. So let's say they even got cheaper contracts than that. Let's go all the way up. Let's see. So you see they got $36 contracts, $29 contracts, $24 contracts, $23 contracts, $19 contracts, $18, $12, $11 contracts, $8 contracts, $7 contracts, $4 contracts, $3 contracts, $2 contracts. So you see it's all the way up to $2 contracts here. But the thing is, with these contracts, you just make less money per dollar that the price moves. So let's say we got this $200 or this $2 contract right here. Let's see what you see the delta on this contract is only 7 cents. So you would only make 7 cents every dollar that Tesla went up. So let's say $28.79 it moved today times 7 cents. You would only made $2 today. So yeah, you would only paid $2 for the contract, but you would only made $2. So that's what happens when you buy cheaper and cheaper contracts, which that's a 100% gain. If you you really think about it, you pay $2 for it, you make $2. That's 100% return, which is good if that's all you had to work with. But you would really want to play with some bigger contracts up here, just so you got a better chance of seeing some money. At least something in this 30-40 range. Don't get me wrong, if you only had like $11 to work with, you can grab this $11 contract. Let's see what that is. So that's 38 cents. So 38 cents, 28.79 times 38 cents. So you would have made $10.94. So you would have spent $11 and made $10.94. So basically down here, you would have just doubled your money pretty much, which ain't a bad move. Let's see if you would have bought. Let's see if you'd have bought this $36 contract, what that would have did. So the $36 contract is $1.27. So you would have made $1.27. So 127 times 28.79. So you would have made $36.56 and spent $36. So you would have doubled your money on that contract. So that's how you buy contracts. Now, one thing I want to show y'all, a lot of times for y'all who already bought contracts, you may have noticed like every time you buy a contract, as soon as you buy it, the price drops down a little bit and you end up in a negative. So this is what you do to kind of help balance that out just a little bit. You see this low offer here under limit price. You see one number says 30 cents, one number says 42 cents. If I was to just jump right in right now and buy this, I would have to pay 36 cents. Now what you would want to do is adjust your limit price. So adjust it to that lower number, at least to this lower number. So let's say so 30 cents, we would at least adjust it to 30 cents. That way, if it gets filled, you get filled on a dip and you're not stuck in it already in the red, or basically you bought it at one price and it dropped as soon as you bought it. Just put in a lower bid and you'll get it for a little bit cheaper than you would have had to pay for it at first. And also another little cheat code or little gem you can do is even put it a little cheaper than the lowest bid price, just in case it drops under there. So you could even set this at 0.20. Let's say it's $36 right now, but if I put it in for 20 cents per contract, I would only be paying $20 for 100 shares for this contract. And that means I'm basically getting a $16 discount if it does get filled. Because if it goes back to this price, then I know, if I get it filled at this price, 20 cents per contract, I know it has the potential to go back to 36 per contract, 36 cents per contract. So now that's an extra 16 bucks, and I'm also not being in the hole once it gets filled. Now, another thing you want to know is the percent change. So this percent change here, where it says this percent change, these numbers here is the amount the contract gained today. So this contract says plus 61%, plus 33.33%, plus 51%, plus 50%. This is how much these contracts gained today. So you can see that if you would have bought this contract yesterday, you would only paid, it says previous close right here. You would only pay 27 cents for this contract yesterday. Today it's worth 36 cents. So you would have gained about $9 on this contract just from holding it from yesterday. Plus whatever it would have, plus whatever the share price increased. So that's just a basic run through. If you got some questions, drop them on the comments of this video, message me, whatever, and I'll be happy to answer them. Also, check out the course right now. If you message me now, you can get the course for 50% off. The normal or regular price for the course is $9.97. You can get it right now for $4.97. Limited time offer only. Message me. I got you, man. A1 gang, we out.